The money you see in your bank account isn't really there. This isn't a metaphor or a conspiracy. If everyone tried to withdraw their cash at the same time, the banking system would collapse within hours, simply because the physical money does not exist. This isn't a glitch, it's how the global financial system was designed. It's a centuries-old setup we've all grown used to, even though it quietly drives debt, inflation, and the illusion of wealth. It's called fractional banking. Once you understand how fractional banking works, you realize that most modern money is built on promises that can never fully be kept. To see where all this began, we have to go back to medieval Europe, long before banking apps and digital currency. Back then, real money meant gold and silver. If you were wealthy, you kept coins, jewels, or other valuables that you could trade. But carrying gold around was risky, so people started storing their valuables with goldsmiths, who had secure vaults. The goldsmiths gave them a receipt, a simple note saying they could return and collect their gold anytime. People soon realized they could trade these receipts instead of the heavy coins. The paper still represented the gold, but it was much easier to use. And this simple convenience became the foundation for the banking system we know today. The trick started when goldsmiths noticed a pattern. Almost no one came to withdraw their gold at the same time. Out of 100 depositors, maybe 1 or 2 would show up on any given day. That meant most of the gold sat untouched in the vault. Seeing this, the goldsmiths got bold. They began issuing more receipts than the gold they actually held. If they had 1,000 coins, they might issue 2,000 receipts. They lent out the extra receipts and charged interest, earning money from gold that didn't really exist. As long as everyone didn't demand their coins at once, no one noticed. It was money created out of thin air. This wasn't just a clever trick. It changed everything. Once people accepted paper claims as equal to real gold, money creation no longer depended on physical metal. Early banks grew directly out of this practice. By the 17th century, even governments embraced it. The Bank of England was created in 1694, not as a public service, but because the crown needed money to cover debts from endless wars. The bank loaned the government far more money than it held in reserves, in exchange for steady interest payments. And those payments came not from new treasure, but from taxes on ordinary English citizens. If that sounds familiar, it's because the same system is still used today. Governments borrow money that doesn't actually exist, and future generations pay the bill. The United States ended up doing the exact same thing. Early American banks printed banknotes that were supposed to be exchanged for gold. But they quickly figured out they could print more notes than the gold they actually had. Every so often, the truth came out. People would rush to the bank in a panic, all demanding their money at the same time. And when the banks couldn't pay everyone, they collapsed almost instantly.
But instead of ending this risky system, the government expanded it. They created central banks to bail out regular banks when the illusion started to crack. The message was simple. Even if the money isn't really there, the public must keep believing the system works. Now let's look at how this plays out today, because fractional banking can feel like magic. Imagine you deposit $100 into your bank. You might assume that full amount stays in your account, but the bank is only required to hold a small part of it. For example, if the reserve rule was 10%, the bank would keep $10 and lend out the other $90. The borrower spends that $90, and the store owner deposits it into another bank. That bank keeps $9 and loans out $81. This cycle repeats again and again. By the end, your original $100 has turned into almost $1,000 moving around the economy. But here's the twist. Only the first $10 exists as real cash. The rest is created as debt because every new dollar comes from someone taking out a loan they must repay with interest. If that surprised you, here's the real twist. The story you just heard is already outdated. In the United States today, the reserve requirement isn't 10% anymore, it's 0. Since March 2020, the Federal Reserve has told banks they don't need to hold even a single dollar against customer deposits. This means the old idea of the money multiplier doesn't really guide bank lending anymore. So if banks don't need reserves, why can't they loan out infinite money? Because the limit today isn't reserves, it's capital and liquidity rules, set by a global framework called Basel. These rules were created by central bankers and regulators after major financial crises, especially in 2008. They meet in Basel, Switzerland, at the Bank for International Settlements, often called the central bank of central banks. These rules aren't made by Congress or Parliament, but by unelected experts. Here's the basic idea. Banks must show they have enough equity capital to survive possible losses. For example, if a bank wants to make a risky $100 loan, it may need to hold $8 of its own shareholder money as protection. The riskier the loan, the more capital the bank must set aside. Banks also need enough liquid assets, things like cash and government bonds, to survive short-term shocks. These rules are meant to prevent banks from taking on more danger than they can handle. But notice how the system changed. Banks don't lend out deposits anymore. They create loans first, and the loan itself creates a deposit. When you take a mortgage, the bank doesn't grab cash from a vault, it simply types new money into your account. That money exists only because you promised to repay it. Then, afterward, the bank checks whether it has enough capital to support that new loan. This is why over 90% of the money in circulation today isn't central bank money, like cash or reserves. It's bank-created money, created from nothing when loans are issued. So think about what sits in your checking account. It's not the same kind of money the Federal Reserve prints. It's money created by banks, and it exists as debt. The money supply grows as long as banks keep finding people willing to borrow. And this is why every financial crisis is really a crisis of confidence. If borrowers can't repay or banks can't refinance their obligations, the entire system begins to fall apart.
This system leads to three unavoidable outcomes. First, inflation. Because banks keep turning the same dollars into more and more credit, each dollar loses value. Prices don't rise only because of supply and demand. They rise because the currency gets diluted. Second, endless debt. Money is created through loans, which means there is always more debt in the system than actual money to repay it. And with interest added on top, the cycle never ends. Someone must always borrow more, refinance, or eventually default. Third, growing concentration of power. Banks earn interest on money they didn't actually have. Governments use this system to fund wars, social programs, and bailouts without directly raising taxes. Meanwhile, the wealthy who own assets, like real estate, stocks, and commodities, see their wealth grow with inflation, while ordinary workers watch their wages lose buying power. When this system stumbles, the illusion shows its cracks. During the Great Depression, banks had loaned far beyond their reserves, feeding a huge stock market bubble. When panic hit in 1929, people rushed to pull out their money, but it wasn't there. Thousands of banks collapsed. The same pattern repeated in 2008. Banks had expanded credit through mortgage-backed securities, inflating a housing bubble built on promises, not real value. When homeowners began defaulting, the system almost collapsed again. Governments and central banks responded the only way they could, by injecting trillions into the system to keep it standing. They rescued the illusion because without it, the modern economy would stop functioning. This is where the global picture becomes important. In the United States, reserve requirements are now zero. In places like Europe, the United Kingdom, Canada, and Australia, reserve rules had already faded or become mostly symbolic. All of them rely on Basel regulations instead. Meanwhile, in countries such as China, India, and Brazil, reserve requirements still exist, often in double-digit percentages, and are used to control how fast banks can lend. But even there, the Basel capital rules still apply on top of everything. No matter where you live, money creation isn't limited by deposits in a vault anymore. The real limits come from rules written in Basel, Switzerland.
Here's the uncomfortable reality. This system cannot function if everyone becomes debt-free. If every household paid off all their loans tomorrow, the money supply would shrink instantly. Banks would have nothing left to lend, and the economy would freeze. The entire structure depends on people borrowing, spending, and trusting that the digits in their accounts represent something real. You are both the fuel that keeps it running and the collateral that holds it together. This is why history matters. The same basic trick used by medieval goldsmiths has simply been scaled up into modern finance, and the same risks are still here. Bank runs in the 19th century, the Great Depression in the 20th, and the global financial crisis in the 21st all prove one thing. When confidence breaks, the system collapses fast. Yet every time the response is predictable. Patch the system, reinforce the illusion, and continue forward as if nothing changed. So what should you take away from all this? First, money is not wealth. Real wealth is land, resources, skills, knowledge, and independence, things that hold value even when paper promises fail. Second, debt is not neutral. It powers a system built to benefit lenders, governments, and asset owners more than ordinary people. Third, inflation is not an accident. It is part of the design. Every year, you're pushed to run faster just to keep your quality of life from slipping. Does this mean everything is doomed? Not automatically, but it does mean you need to rethink how you view money. Simply saving cash in a bank won't protect you. Trusting the system without question won't help either. Real financial freedom comes from building real wealth, things that hold value outside the endless cycle of inflation and debt. This isn't about fear, it's about awareness. If money enters the system as someone else's debt, then your freedom depends on understanding that machine and stepping beyond it when you can. History may not repeat, but it definitely rhymes. The goldsmiths of medieval Europe, the bank panics of the 19th century, the housing crash of 2008, all follow the same pattern. A system that multiplies promises faster than reality, and a public that believes until the illusion breaks. And this story isn't finished. Every major financial crisis reminds us that the system doesn't rely on gold or productivity, it relies on confidence. And confidence is the easiest thing to lose. So, the next time you check your bank balance, remember, most of that money exists only on paper, built on a structure of debt that was never designed to protect your freedom. When you understand how the system works, you can shield yourself from it. If you ignore it, you remain just another player in a game where the house always wins. Don't miss what history is trying to teach us. Hit subscribe before it's too late.